Hey there, welcome back. So in this video, we're going to be talking about why we trade options, what they are, and how they work. Now, we've already got into it a little bit. In one of our earlier sections, we discussed a little bit of what calls were, what puts were. I mentioned that options were contracts. But in this section, we're going to really, I guess, more break it down what all of those things mean to us. So options are contracts. They're not actual assets or equity. You don't actually own the stock, ETF, or whatever you're investing in through the option until you decide to use the option. The options give the option holder the right to either buy or sell shares of that underlying asset. Now, one option has control of 100 shares of the underlying equity, unless otherwise specified, which there are non-standard options you might encounter, or you'll likely encounter the longer you trade. But we're really looking for options that control 99% of the time. You're going to be trading options that control 100 shares of an asset. Okay. Now, options do not give you ownership. They're contracts which increase and decrease in value as price rises or falls. They're directly correlated to the price of the asset. How much they're worth totally depends on how much the asset is worth. Now, options allow traders to control and profit from a large quantity of shares at a fraction of cost. We already talked about in previous section that stock that was worth $100. We could buy 100 shares for 10,000, or we could buy one option for 500. That one option, if price goes up $10 in the next day, would make 200% return versus the stock, which only would make 10% on a $10. So options provide leverage, and they also provide traders a way to insure their assets and create an additional source of income from their assets, from their capital. Also, keep in mind that options must expire within the current price to have value. Remember, we're talking about if it's usable at expiration. Does it have any value? Is there any point in using it, or is there a better deal to be found by just buying or selling the stock at current price? If buying or selling the stock at the current price is a better deal than the deal your option provides, then you don't want to use your option. So the option must expire within the current price to have value at expiration. Now, we also need to be talking about the buyers of options versus the sellers, because buyers have rights, but the option seller has obligations. It doesn't matter as an option seller if the option has lost the seller a whole lot of money. If, say, you sold a $500 call and price goes to 550, it doesn't matter that price is at 550. That person that bought the contract from you has the right to buy your shares at 500. Great deal for them, not so great for you as the seller. So just something to keep in mind, that the sellers are obligated to fulfill the terms of the contract, whereas the buyer has the right to either fill the contract or not. It's totally at the buyer's discretion. So when it comes to buyers and their rights, when we're talking about calls, buyers have the right to purchase shares. And when it comes to puts, the buyer of the put has the right to sell shares at that agreed upon price, which is known as our strike price. Now, sellers have obligations. The seller of a call option is obligated to sell their shares at the agreed price to the option holder, whereas the put seller has the obligation to buy at the agreed upon price from the put buyer. Okay, so in conclusion here, options increase your buying power. One option gives you the right to buy or sell 100 shares at a specified price. One option obligates the seller to complete that transaction. Whoever you bought the contract from must fulfill the terms of that contract. That's the deal that they made. So And then last, we have options must expire within the current price, trading price, to have value. We want to make sure it's usable and there's a point to using it. So options also have characteristics such as, what kind of option is it? Is this a call option? Is this a put option? On what stock are we trading these options? So we'll have, say, SPY call with a strike price of 500 and an expiration date of this Friday, gives us the control to buy SPY at 500 by Friday, 100 shares of it, if we choose, if the option has value at expiration. Okay, so whenever we see this written out, for example, you might see SPY the 14th of January 2022, 465 put, controlling 100 shares. Okay, so that's just simply how it will be written out. So in conclusion here, the holder of an option has the right to trade shares of a specific company or ETF. The option gives you the right to either buy or sell, and that's distinguished by its call or put term. The price at which you do the deal is going to be your strike price. The day by which the deal must be completed is your expiration date. And the number of shares it controls will be typically 100 per option. Okay? So how are these options priced? When we're looking at a stock, say SPY, it's priced purely based on how much people are willing to pay for it, right? But options also include speculative value. Since they're significantly cheaper than buying the stock, these options have the ability to make significantly more. For example, if price of the underlying asset may rise $10 in the next week, that value has to be priced into the value of the options. We call this the speculative value. This is also time value. This is how much the option, this is also your vega, the implied volatility of the option. But something to consider is that a lot of moves, a lot of the movement in the market is priced in. And when it comes to options, it's priced into the value of the options, how much price is expected to move. So most options are going to lose value every single day as expiration approaches, and the likeliness of price traveling as far as it can decreases. So the more time an option has to travel, the further it can potentially go, right? If you're holding an option, right now price is $1 on the stock you're looking at, but you're holding an option for 3 years. Well, in 3 years, who knows how far that stock can go, right? But now you've traded that option in, and now you're holding an option that expires on Friday. What are the chances that that stock by Friday hits $100? Probably less, right? Maybe in 3 years it could do it, but in the next 5 days, it's gonna be a little harder. So the more time an option has to travel, the further it could potentially go, and that has to be priced in to the value of the option. It's speculative value. And the closer an option gets to the expiration, that speculative value comes out. It's priced out of the option quicker and quicker. So when we're talking about pricing options and the different factors that we need to think about, there are actually, we do this through the Greeks. So first we have delta. I'm going to focus on we're going to talk about all of them, but the Greeks are how we price options, and we do this by determining how much buying power an option has, how much control it has based on where price is. We think of this as the delta. This is how much an option can gain or lose for every $1 change in the underlying asset, okay? So if you have a delta of 50, if price goes up $1, the option will gain $50 in value. If you have a delta of negative 50 and price goes down $1, the option will gain $50 in value. So I don't know if that sounded a little confusing. Let me try it one more time. If the option has a delta of 50 and price goes up $1, we make 50 on that option. But if it has a delta of positive 50 and price goes down $1, we lose 50. So I flipped it the last time I said it, and I said, but if we have a negative delta, because we can, puts have a negative delta. If we have a negative 50 and price goes up $1, that option will lose 50. So hopefully that cleared things up. We also need to know what the option's vega is. This is how much an option's price will change with every 1% move in implied volatility. Implied volatility is simply how far price of that asset is expected to travel by expiration day. Okay, so by expiration, market makers have an idea where price will end up, and they try to price that in. Sometimes that number will drastically increase or decrease, perhaps around earnings. Maybe during earnings, when options get inflated in value, twice as expensive as normal, for example, that the vega, the IV of those options, is also 2 times normal, saying that price is looking to move potentially twice as far as it usually does. Keeping in mind that if it doesn't, all of that added speculative value must be removed immediately. So here is where we can see implied volatility in the option chain. So I just have some different expirations here. There's all weeklies, all really near-term options, and we can see represented as both a percentage and as a dollar value that is plus or minus. So on this one, January 10, 2022, within the next 3 days of taking this picture, price on this asset was expected to either rise or fall $4.20. Okay? So each expiration has a number that's represented as both a dollar value and a percentage. And this is going to be known as your implied volatility for that option. Understanding how much a stock is expected to move can help you, really help you appropriately prepare for your trades. Especially, say, on SPY, on the market, which is a much more predictable asset, especially when we have a strong indication that it's going to be a choppy day or kind of a range-bound market. Market internals are flat. Maybe they're suggesting it's really just going to be choppy. We can execute that debit butterfly spread I mentioned earlier in this training, in this course. We can execute a debit butterfly around the expected move. We understand, for example, that today, this option that's expiring today, price on the market, for example, might only be moving $1.58 today. Now let's say price opens $1.58 lower. Well, kind of already did the move. Probably not going to go anywhere else today. We might just open and close around the same area, and it might be a good day to put on a debit butterfly, depending on what market internals tell us. So just knowing how far price can move can help you set the right expectations of where it will move. If price, on expiration day, the day that it was expected to move another $1.58, if it opens $1.60 higher or lower, you might say that the move that was planned for that day happened, was priced in appropriately, and that anybody buying out of the money options, anybody buying options expecting that move to continue much further, is probably going to have a tough time because the move already happened. So it's just something to think on, because there's definitely, absolutely profitable trades to be found just by knowing what the implied volatility is, by figuring out where price is opening today versus where it's expecting to expire today, things like that. Then we need to also talk about our gamma and our theta. Gamma is simply how much the option's delta will change for every $1 change in the underlying. So gamma just tells you how fast an option's delta will increase or decrease. You might buy a 50 delta option, but as price moves in your direction, you'll see that that option goes to a 60 delta, to a 65, to 70, keeps rising. The longer you hold it, the more price continues in your direction, the closer you get to a 1 delta. A 1 delta is 100% in the money and will be used at expiration by somebody. So the closer you are to expiration, the higher your gamma. So an option that is expiring today, a 50 delta option that is expiring today, will have a significantly higher gamma than a 50 delta option that expires in 3 months. The option that expires today, a $1 move in price might turn that option into an 80 delta, whereas a $1 move in price on the 3-month option might only make it a 52 delta. So the gamma is going to increase exponentially as expiration approaches. Now, another example of where something increases exponentially as expiration approaches is theta. Theta is our speculative time premium. This is that premium that's priced in saying, how far can price potentially go? We have this much time left. How far could it get? As time goes, as time goes, doesn't go away, but as you go through time and there's less time for your trade to work, your trade has less and less potential to move further, right? So as that happens, speculative premium is being removed from the price of your option. And the closer you get to expiration, the faster it is removed, especially for at the money, just out of the money options. So keep that in mind, that the longer you hold on to an at the money option that stays at the money as expiration approaches, the more theta gets removed. When you first buy an option, maybe you have a month on it, you might have a theta of 9, meaning every day you're going to lose $9 in speculative value per option. But as you get to expiration day, that same option might have a theta of 80. By the end of today, it's going to lose $80 unless something happens. Unless something profitable for that option happens, it will lose $80. And keeping in mind, even if something profitable happens, if you have, say, a delta of 50 and price moves $1 in your direction, and you have a theta of 80, you're still down 30 at the end of the day. That option still lost money. The theta could not the option's delta, how much it was standing to make for every $1 change, could not overcome time decay in that amount of time. Not enough time for the option to go far enough to make money. So it's definitely a really good idea to pay attention to the relationship between the options you're trading's delta and theta. These are the two most important Greeks to be aware of, to pay attention to. When it comes to gamma and vega, you should know what they are and know how they apply. But delta is how much you make. Theta is how much you're going to lose. And you want to know how much your option will bleed. That's what it's doing. It's bleeding every day unless it's working. And if it's working, it bleeds less. And the more delta you get, the less it bleeds. So the more a trade works out for you, the less of a problem theta is to your trade at all. On expiration day, an option with a 1 delta has a 0 theta. And as long as it stays with its 1 delta, it doesn't lose any money because it has value. It will be used at expiration. So if you can get your options deep in the money, then theta is less of an issue, okay? Because the curve on theta is exponential. Options from say 120 to 90 days, they barely lose any speculative premium. Then from 90 to 60, it starts to pick up. From 60 to 30, much faster. But then under 30, it's exponential, dramatically faster. You might find, like I said, an option with say 90 days on it might only have a theta of 5. Maybe it loses $4 per day, something relatively small. But an option that expires on Friday, say 4 or 5 days from now, might have a 25 theta or 30. And every day that number goes up. So something to keep in mind. So for a recap, all options, or an options delta simply tells you how much the option will gain or lose in value per $1 change in the asset. The vega tells you how far price is expected to move by expiration. Gamma will tell you how quickly your delta will increase or decrease per $1 change. Just keep in mind with gamma that options with longer dates have a low gamma, and options with short dates have a very high gamma. So your delta can go up and down much more quickly. And then keep in mind that an options theta will tell you exactly how much that option will lose in speculative value every single day as expiration approaches. And remember that theta number will increase every single day as expiration approaches unless the option gets deep into the money. So something very important. Because deep in the money options have a whole lot of intrinsic or real value. This is an option that is going to be used at expiration to purchase or sell shares. It's a deal you'd actually want to make, no question. Whereas options that are out of the money have speculative value. These are options that maybe by expiration will have use, but as of right now, we're trying to buy something cheap in hopes that it will dramatically increase in value. That's really why most people trade out of the money options. They're looking for this big 300% return. They're trying to have this huge win. And honestly, it's usually unnecessary, and it leads to more losses because the odds of an option that's out of the money expiring in the money, especially the closer to expiration you are, is smaller. It's just odds. It's just statistics. So it's typically a much better idea to buy options that already have real value baked in. And I recommend buying at the money options. Don't buy options with a delta less than 30 for sure. Typically, I really want to be a delta higher than 40, more targeting the 50 delta area. Because these options, 50 delta particularly, already have some real value baked in. And once price starts to move in your direction, these are the options that get in the money, then deep into the money. These are the options that will have real value if your trade works. If you're trading options that are purely speculative, if your trade works, the option still might have zero value at expiration. You might have a great trade, but it was so far out of the money, you could not overcome theta, and it just ended up bleeding. That can happen if you're not trading the right options. So I recommend that you don't trade options with a delta lower than 30 ever, and really you more target options with delta around the 50 range. These are options that already have some real value baked in. So when we're looking at the options chain, everything in the blue are options with real value. Everything in the black are options with speculative value. These options will only be used at expiration if they can work their way down here. Keep in mind, these options are losing $19, $20, $22, $23 every single day as expiration approaches. If you're losing 22 out of 108, you're losing 20% almost every single day of your investment, just in the hopes that it might end up down here. Whereas if you're buying these, it's a much smaller fraction of your investment, right? A significantly smaller fraction of your investment that you're risking every single day. And the deeper you come down here, you'll start to see that this number goes down. And you come way down here where they're 1, theta is very small. These options are barely losing any speculative premium at all. Okay? Because they're options that are usable. They will be used at expiration. They have a lot of value, real value. So the option strike price must be trading within the current price to be used. Price is at 466.71. All of the puts here have value. All of the calls here can be used. It's a good idea to buy at 466 if price is already at 466.71. Not that it's a deal by doing it this way, but at the moment. But if price were to rise, owning something at 466 that's trading at 466.71 sounds like a good idea. Selling something at 467 that's trading below that number is obviously a good idea, especially if you bought these for cheap and price, maybe you did buy them down here and it rolled all the way up here. Now you bought a put, you covered your investment, you're doing really well. So just something to keep in mind. So key points, there is no point in buying and using an option to buy shares for a price higher than it's currently trading at. And there's no point in using an option to sell shares for a price that's lower than it's currently trading at. These two types of options are worthless. And at expiration, they go to zero. Also, we want to keep in mind that options that trade in the money have real value already built in. And we really want to be trying to trade options with real value, or options we do expect to have real value at expiration. Options that trade out of the money have speculative value, extrinsic value, and little to no intrinsic real value. They're not usable until price moves in their favor. Now, if we're trading inside the day, maybe we want to trade slightly out of the money 45, 40 delta options, no lower than 30 for sure. Typically, I like to be higher than that. But we might trade these out of the money options because we're only in and out inside the day, and we're not really holding long enough for theta to be a problem. If you're only holding on to a trade for, say, 1 or 2 hours, maybe a little bit longer, then theta isn't your biggest risk, especially if during that time frame your out of the money option went into the money, right? So yeah, that's going to be it for this section. I hope you guys got everything or learned everything you need to know about the basics of options. There's going to be a lot more. We're going to get into them later, especially when we get into strategy and actually executing trades, figuring out which options we should be buying. I have a very specific method for identifying the exact options I want to be trading when I'm day trading, when I'm swing trading, when I'm selling calls, when I'm selling puts. I know exactly the ones we want to look at. So we'll get into it in much more detail later, but this is a really good overview, hopefully to give you a strong understanding of how options work and how they are used in trading. So in the next section, we're going to start getting into our basic technical analysis. We're going to start learning to read candlesticks, identify support, resistance, trend lines, and then we're going to go into think or swim and start practicing how to do it all. So I will see you all there.